Right, good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. With that song, The Eye of the Tiger, you have to ask, is it the eye of the storm, perhaps? From the BCI team, we want to welcome you and thank you for joining us and your continued support. We really appreciate of that always. High rates seems to be the narrative at the moment. Although SA equity looks very cheap, what impact will higher cost of capital have on a shrinking universe of listed companies on the JSE? Is there still room for clients to make good earnings or companies to make good earnings? We will see a lot of that today or this morning. SA bonds also remain attractive, offering yields of roughly about 12%. It's been the case now for some time as well. But with SA facing numerous headwinds going into an election year, will SA investors benefit when global factors turn positive, and to what extent? Here to cover all of this and more, joining us this morning from Anchor Capital is Nolan Wappenaar, Chief Investment Officer and Fixed Income Manager, to share the views on global fixed income and the SA fixed income environment. And he's also joined by his colleague, Liam Hafter, all the way from London, very early morning that side, to look at SA equities. Good morning, Nolan. Good morning, Liam. How are you doing this morning?
Good morning, Eugene. Lovely to be back here. Hello, everybody.
Good to have you here. Nolan, we're ready for you. If you are ready to go, you can share your presentation and giving us all the good news you want to.
Let's have some fun, and I'd like to think it is actually good news. There's light at the end of the tunnel, or at least at the end of the road, as you can well see. So good morning, everybody. I'm going to talk to you for the next 15 minutes or so about the global macro environment, about what that means for bonds, and then hand over for Liam to explain what that all means for equities. It's going to be a bit of a trot, so I'm going to chat rather quickly, and obviously the presentations will be shared afterwards. So with that in context, the way I want to start this is by looking at what I think is actually the most important chart at the moment. And it's a chart that focuses on inflation and interest rates. So what we have got here is a chart that shows you US inflation rates. So that's that sort of brownish jagged line. And you can see how inflation has sort of bumbled around somewhere around 2%. And then post-COVID got completely out of control, and it's now been coming back. Very importantly, the blue bar at the end hasn't actually occurred yet. That's the future. That's what the US Federal Reserve is telling us is going to happen. And you can see how inflation sort of spiked at 9-ish%. Actually, the graph looks a bit stranger. And it's been coming down since, and the Fed is basically saying end of next year, 2.5%. So that's where we're going. The other line that you see is the blue chart, or blue line, and that is interest rates. And you can see how, in the early 2000s, rates were hiked. We hit the global financial crisis. Interest rates were cut to nothing, bumbled along forever. We started to normalize. COVID hit us. And then we get to 3 years ago when inflation panic set in. And it has been a very tough investment 3 years. And interest rates went from basically 0 to 5% very, very quickly. And they're sort of expected to possibly go up a little bit more and then stay at these levels higher for longer for the next year. So that's what the Fed is telling us is going to happen. That's what we've been through. And the sort of fastest interest rate hiking cycle in memory has been very, very painful. But what I want to look at is the differential between these two. So if we take the actual interest rate in the US minus inflation, that gives you the real rate, basically. So how much are interest rates higher than inflation? And you can see here sometimes interest rates were higher than inflation, sometimes lower than inflation. So let's graph that. Let's graph the differential, and that's all you're seeing here is the real rate. And you can see how into the global financial crisis, the real rates were quite high, then they dropped again. Real rates became ridiculously low through COVID as we put a lot of stimulus in, notwithstanding inflation, and there's been a big catch-up since then. Now, economists, I don't have Darby's roots on the presentation today, but economists will tell you that what matters to to economies is actually real rates. So everyone goes, yes, they hike interest rates, the economy slows down. Yes, but it also does depend on real rates. And in fact, the handbrake is real rates and how positive they are. So you can see here, for instance, since the global financial crisis, real rates were negative. We were in actually a stimulatory sort of environment. Through COVID, we were in a ridiculously stimulatory environment. And then leading into the global financial crisis, we were actually in a restrictive environment. But the point is, if we look at what the Fed has told us here, which is the differential, is that as inflation comes down and interest rates stay the same, the world is going to see real rates just keep pushing higher. And in fact, it becomes increasingly restrictive over time. How restrictive? Well, based on the Fed's forecasts, by the end of next year, we are going to be as restrictive as we were at the time that the global financial crisis was sparked. So it's actually quite restrictive. And last time it was this restrictive, we ended up in a sort of 10-year crisis. So we've got to bear that in mind. And that's actually what's driving a lot of our views right now is, you can hike rates, you can keep rates higher for longer, but if your real rates get too high, it starts to become a big problem. Now, the issue with that is there are three scenarios we need to consider. And the first scenario is that, history doesn't really sort of explain what's going on right now, and that the US economy stays quite strong, interest rates stay higher for longer, there's no landing, and, we just go off to the moon. That's, in our view, an unlikely scenario because as rates get higher and higher, we all know it's a handbrake on the economy. We are seeing job growth slow, we're seeing earnings growth slow, and eventually, something will break. The second scenario, which is sort of the middle panel, is one where the handbrake has come up, and this handbrake results in sort of ever slower economic growth, and we just see a sort of gentle landing, if you want, of the economy, where things slow down quite markedly, and eventually the Reserve Bank or central bank goes, let's just release the pressure, cut a couple of interest rate cuts. It's not a sort of emergency cut, and we just sort of normalize things. Everyone high fives each other. Well done. That is probably Anchor's base case scenario. Then on the right-hand side, when last time real rates were this high, we had something break. It was the mortgage market, and the housing market broke, and we ended up in a recession that needed quite drastic action. Certainly not our expectation this time around, but it is something we can't take off the table. And we look around and we say, well, what could break? Nobody really knows until it breaks. That's the problem with these things. You're never quite sure where it's going to go wrong. And it was a surprise when mortgages went wrong in 2008. At the moment, people are pointing either at the sort of private debt market, saying these are very big at the moment, and I think there's truth to that. I'm also seeing people pointing at the commercial mortgages. So your property company is saying there's a lot of debt leverage in there. Also true. So I don't know. I'm not saying any of those are going to break, but there are definitely risks that as interest rates go up, something will eventually break. And we've got to be aware of that as well. So that factors into our thinking. So the issue and the point I want to make is that in a recession environment, we see drastic interest rate cuts very, very quickly where something is breaking. In a slowing growth environment, we see interest rate cuts, just a progressed sort of more measured approach to it. And in the last scenario, we actually see interest rates pretty much stay where they're at right now, and the market will actually do the Fed's work for us. What does that actually mean for bonds if we think about it? Well, the two scenarios in the middle and on the right are actually very bond positive because you're going to see capital gains. And the scenario on the left is actually kind of bonds neutral. You're going to earn good interest income, but you're not necessarily going to see capital gains on top of that, but you're still in a good place. So that actually speaks to how we're thinking about the world right now. And we published in our Navigator about 2 weeks ago, our asset allocation views. And you kind of got the three scenarios in our view of how markets perform. But the point is that if you look at the global environment down the bottom, for the first time in Anchor's history, we're actually positive on global bonds. And we're saying that there is an opportunity here to earn your 5% interest income plus a reasonable prospect of capital gains. How big are the capital gains? I don't know. In some of those scenarios, you could actually end up with a 1-year bond return of 15–16% in dollars. In other scenarios, we're going down to about a 5% return in dollars, but that's our range. And we're saying that's actually quite an attractive environment to be in the context of where other financial markets are pricing at the moment. So we're kind of, for the first time in our history, thumping the table and saying, guys, global bonds, you've got to get a piece of this. And that's how we think about it. Domestically, as Eugene was saying, we're a little bit less excited. I think global environment is going to turn positive, and thank goodness it's been a dreadfully challenging 3 years. I think a positive global environment helps, but there is going to be a bit of a tug of war, as I will explain in a minute. So I've already explained our view on global interest rates. You know, the US 10-year bond was 4.8 when I put the presentation together, it pushed above 5, I think 2 days ago. So, you know, 5% yield, 5% returns locked in, plus capital gains. Nice, nice, nice. We've got to be investing in global bonds. How do you do this? Anchor BCI Global Flexible Income Fund. I stress the word global there. Anchor BCI Global Flexible Income Fund. We're buying exactly these bonds that are going to give you this return. So from that perspective, speak to Eugene, speak to Tanya. You know, I think this is where clients and investors want to be for the next couple of months, at least probably the next year or two. Looking domestically, it's all about tax collection. It's all about the fiscal pressure, and that's all the markets are talking about. The reality is that the tax shortfall is about 50 billion rand. It's a lot of money. It's a heck of a lot of money, but it's not catastrophic. And the first point I'll make is that of that 50 billion rand we've got to find, about half of it is found pretty easily. Just the money that wasn't spent last year, don't reallocate it. And take, you know, take guys who are close to retirement and let them retire a little bit early, push them to the PIC. It's actually in everyone's interest to do that. It works very well. So I think that, you know, half of the hole in the budget is very quickly fixed. That leaves us with about 25 billion shortfall. That's a little bit more tricky, but they're probably going to absorb that with debt in the short term because it's an election year. Let's be quite blunt. Thing is that if you can manage all of this, it's not catastrophic, it's going to have a small impact on our debt numbers. What is really the issue? And what we really need to do is fix the failing state. We need to fix Eskom, we need to fix water supply, we need to fix Transnet. We actually need to successfully prosecute more people than 1 every 3 years, whatever it is. And from that perspective, that is what we're looking for. I think this is, you know, this is where the focus needs to be. And, you know, the numbers behind the scenes, I think National Treasury can manage. So we're seeing some action on these levels. I'm going to argue it's not enough. We need to take drastic action. But this is really what South Africa's future is about, and this is where it's going. This is what's going to drive bond yields in the long term. Yes, in the short term, we've got a mini budget next week, Wednesday. It's going to wobble a bit. I think it probably comes out a little bit weaker. Nobody rationally is expecting a good budget. So, you know, it's in the price. We're expecting a bad budget. It'll probably be a little bit weaker afterwards, but nothing catastrophic. It's all about fixing this failed state delivery, and that's what we're looking for, and I think that's what would drive bonds. So domestic bonds, what does that mean? It means that you've got this tug of war. The global environment is going to be more positive. That's going to pull bonds stronger, but domestically it's moving slowly, and that's going to pull bonds negative. And this tug of war is going to create a lot of volatility on domestic asset classes, a lot of volatility on domestic bonds. You know, in the long run, I think our bonds are actually quite attractive. You're earning 1% a month, but it's going to be a bumpy ride. It's been a tough ride. When you're looking for capital gains, I think the capital gains are more clear offshore. I think they're more likely offshore. Domestically, some of the negative factors will sort of hold you back from capital gains. So that's how we're thinking about domestic bonds. In that context, if you are looking for domestic bonds, we've obviously got the Anchor BCI bond fund. Have a look at that. You know, it is an attractive option to get some exposure. Yeah, I think you need some exposure, but I would probably tilt it a little bit towards offshore. Very finally, just pulling it together, we've got 3 fixed income portfolios domestically on the BCI platform. The Anchor BCI Core Income Fund, designed to be stable. It behaves a little bit like a bank account. You put cash in there, it earns interest income. You take the cash out, you stop earning interest income. They hike rates, they cut rates. Your capital value is pretty steady. What you end up with is you just accrue more or less over time. It's been a phenomenal safe haven over the last while, and the portfolio net of fees is running at about 9.3% for investors. We blend in a little bit of bond funds. So people are basically saying, well, I want to lock in interest rates because I think cuts are coming, and I get that. So I buy a fixed deposit. If you want a 1-year fixed deposit, you buy the Anchor BCI Flexible Income Fund. A 1-year fixed deposit yields a bit more, and effectively you're locking into rates. So there's a bit of capital gain when rates do come down. And then finally, if you want a 5.5-year fixed deposit, you buy the bond fund. That's actually what the portfolios are in essence. But with that, with saying that, you know, we're quite excited about bonds, quite excited about our portfolios, I'm going to show you the disclaimer because compliance told me I have to do this, and I am going to hand over to Liam. Thank you very much.
I am here. Sorry. just need to share my screen, sorry. Morning, everybody. Assuming you can hear me all fine. Nolan, just shout if you can't. So yeah, I've got the unenviable task of discussing South African equities in the context of what Nolan has been discussing. We presented this set of slides a week ago, and I did have a different title, Dr. Jekyll and Hyde and Mr. Hyde. That was the original title, and we'll get into why it was a little bit later on. But Mike and I were discussing yesterday, maybe we should change the title of the presentation to Waiting for Godot, because we've been sitting here saying a very similar message about South African equities for a while now, and it hasn't necessarily come to fruition. But in terms of the way we shape our portfolios and in terms of our strategy, there's a clear reason behind why we've done what we've done, and how we've taken the current landscape and why we think our current investment approach, which has been very steady over the last 10 years, will prevail over time, and why it's appropriate for South African equities. So just a quick reminder in terms of who the South African equity team is. It's the core equity team is Mike and myself running the funds, and we're assisted by Saleo, who's been with us for 10 years. I've been with Anchor for about 10 years now. Mike has been with Anchor, I think, for about 4 to 5 years. The two of us teamed up as co-portfolio managers on the BCI equity fund and the SA equity fund, after we originally started the fund with Pete and Sean back in 2013. Just a reminder that we do have now a South African only equity fund, so SA equities, which is essentially a carve out of our South African equity portfolio of the BCI equity fund. So the fund has been going since August 2021, slightly above the benchmark since inception. But obviously, listen, I mean, there's no illusions as to how difficult the operating environment has been in South Africa. And as a house that likes to focus on the core tenets of quality, solid management teams, and where there is growth, we would like to focus on growth as well. The environment has not necessarily kicked up a lot of opportunities for us, and we've had to be quite defensive in our approach to portfolio management over the last couple of years. But in terms of what we look for in companies, we're very much very focused on things like the quality factors within businesses, and try largely to shy away from the more cyclical factors that drive company performance, which maybe puts us a little bit, makes us a bit of an outlier in the context of the South African equity landscape. I know that there's a lot more focus on value across the South African equity market. So, you know, listen, we always had that approach, and we weren't really going to change it, and certainly puts us in a smaller category of South African equity managers in terms of how we like to build and construct portfolios. And so listen, we don't have a lot of time. The slide deck was set up for a much longer presentation. I'm going to highlight the slides that I believe are most relevant to this discussion. We've pulled a couple of charts and bits of information across our research universe that we've got, luckily, from both the street and ourselves internally, and obviously leveraged a lot of our economics team, which is essentially Nolan and the fixed income guys, because it's all very relevant today for South African equities. So I'm sure most of you are well aware of the fact that South African equities are really cheap. I mean, that is no secret. They've been derating since essentially Cyril Ramaphosa became president of the ANC. I mean, there was that initial spike. I mean, South African equities always used to trade at quite a nice premium to the rest of emerging markets, but that premium has eroded over time, as you know, that certainly the quality of what you could access across the market had deteriorated, but also the optimism around what the regime change within the ANC was going to bring to South Africa, it just never came to be, or it hasn't yet, essentially. So while we highlight how cheap South African equities are, and essentially how cheap emerging market equities are, it doesn't necessarily scream as in isolation a glaring opportunity. So this is the original template of our views of the South African equity market. So we're in a position now where things don't look really attractive. Cost of capital is probably our key concern across our book, from the sort of July, the sell-off that you've seen from July to now. We across the companies we have exposure to, there certainly hasn't been a further deterioration in operating conditions. I think we were positioned relatively defensively going into the pullback that we've seen since the end of July. What we've seen since the end of July is largely a cost of capital issue, which we'll highlight on the next slide. So, essentially, South African equities and equities in general are priced off a risk-free rate plus an equity risk premium. As that risk-free rate is shot up, which is essentially in South Africa, the South African government bonds, which Nolan's already touched on, so too does the hurdle that you need to apply in your models to justify buying equities. So we believe that a lot of the derating that you've seen over the last 3 months has been more macro related and not necessarily idiosyncratic to South Africa or the businesses that we're invested in. But that being said, there's certainly some strife across the South African equity market. I mean, it has been very disheartening to see companies that we have had exposure to, certainly in the form of transaction capital, but across the South African equity market, what I would consider bellwether, in a way, blue chip South African operating entities turn into losses over the last 12 months. It's been that has gone way beyond the stress factors that we thought that we were going to see across the market. So at the moment, the picture is not necessarily rosy. The better run businesses, higher quality companies are certainly shining. I mean, if you think of a Bidvest, for instance, or a Bidcorp, obviously not much exposure to South Africa, but businesses that have really been able to weather a very tough macro environment across the market. Those businesses have shone through, and you've actually had reasonable performance from them. The macro related factors we've touched on has pushed out cost of capital, and there's been a complete lack of interest across emerging market equities, but also within emerging markets for South Africa. As someone who sits in London, I go to roundtable discussions all the time with people in our industry. You can't actually get a conversation away on South Africa. But as we'll show in the next couple of slides, it certainly highlights a potential opportunity. In terms of the picture going forward, listen, we've written about it in the Navigator. There's certainly a scenario where if you have some kind of normalization in yields, which Nolan's already touched on, I think the South African equity market's geared quite nicely to that. So, where the concentration has come in terms of things like our local banks in the index, the banks are 20-odd% of the index now. Those are priced really closely or tightly correlated off the yield curve in South Africa. We could see easily a position if bonds strengthen by 1 or 2% or yields come in 1 or 2%. There's a good 10 to 15% upside in our local banks. So that's largely a positioning for a macro related outcome. We don't believe that there's necessarily a big earnings cliff coming. Obviously some deterioration across the impairment books, but from our conversations with the banks, they've been very conservative over the last couple of years. And if you look at a bank like Standard Bank, which we'll touch on later, the operating results and diversification within that business have been exceptional. So 30% earnings growth, far exceeding our expectations. And what we also discussed very briefly after this is just how reliant the South African equity market is on China. So we're in a position where everybody's been waiting for some kind of fiscal response from China to act as a counter-cyclical balancer within the global economy. Now, the data that we're looking at that's coming out of China, certainly in certain pockets of the economy, there's clear weakness, particularly in property and fixed asset investment, which South Africa probably has the most gearing towards through our mining companies. But what we think is likely to happen is that there's going to be a broader fiscal response and a much more pronounced fiscal response out of China. I mean, listen, we've been waiting for this for best part of 12 months now. I would say they came out of their lockdowns about 12 months ago. We were expecting to see that fiscal response already. We haven't seen it, But in terms of creating an expectation for South African equities, it's certainly within one of the scenarios we see playing out. So we could be in a position where in 12 months' time, you've got a cost of capital coming in, which I'll show you just how restrictive it is on this slide. So this is our cost of capital over the last 20 years in South Africa, which is essentially taking the bond yield, the South African 10-year bond yield, and adding a risk premium of I think it was 4% that we add as a blended risk premium across our market. That just shows you, this chart literally is the inverse of the PE multiple that you're going to be paying for South African stocks. So the higher this goes, the lower the justified PE multiples are, and essentially is sitting as a noose around our neck right now in terms of it creates a very high hurdle for us to get excited about buying equities. So when we do buy equities, specific companies, because remember we are very much bottom-up focused, our hurdle and justified returns need to be quite high. So that's essentially what we're going for in the businesses we do own. And listen, we've managed to build a portfolio quite nicely across the South African market of both larger companies and quite nicely in the off the top 100 shares list as well. So that the opportunities have certainly presented themselves. We can see that there's enough high quality businesses run by very dedicated and diligent management teams to build reasonable portfolios across South African equities to get good returns. And if you look at returns over time in South Africa, they have been reasonable. They've held up relatively well in places if you favored quality. In terms of that comment I made around our beta to China, this is a great little chart, and obviously you'll get the slides afterwards, just highlighting just how using the actual data in the equity markets, the beta that South African equities has to China. So this is not subjective. This is pure raw data in terms of the beta of South African equities to China. Outside of Hong Kong, which is essentially the offshore access into China, outside of that, South Africa has got the highest beta to the MSCI China index, which I thought was quite an interesting chart, just to justify our views that South Africa is almost like China's little brother. In terms of the South African equity landscape, listen, it's obviously quite concerning that we're seeing a narrowing out of our investable universe. It's a trend that's been going on for many years, and it's continued. And listen, we speak to a lot of smaller companies who are struggling to justify staying listed on the JSE, and largely as a result, and largely as a function of the lack of liquidity and lack of interest. So that certainly creates opportunity for us. We've got a full dedicated process to identifying companies that we think don't deserve or don't need to be listed. And we've constructing sort of smaller niche portfolios to try and target those opportunities, but that trend is deeply concerning. In terms of liquidity, we're also seeing a deterioration of liquidity across the local market. So favoring companies like ourselves with less than 10 billion of assets in a local equity fund, I think puts you in quite a good position. It increases your investable universe quite dramatically. I think that nimbleness is certainly something that is an asset in this type of market, a market where the rising tide doesn't necessarily lift all ships, and that nimbleness to trade in and out of positions when dislocations appear is certainly something that we like to embrace within our process. In terms of the South African equity market and quality deterioration that you've seen, this is just a slide to highlight just in terms of how big the deeply cyclical exposure is across our local market, how much it's crept up over the years, pulled back recently as a result of share price declines as much as we've seen. But once again, highlighting this is clearly a market quite dependent on the outcomes, particularly in fixed assets, infrastructure, investment across China, which drives global commodity markets. But why we don't like those businesses, this is a great slide just to highlight once again, those businesses in those deeply cyclical sectors, you date them, you don't marry them. You need to be cognizant of the fact that when you're in those companies, you're already planning your exit. You need to be thinking that these are not core compounders that you're going to be sitting with over time. You have a clear entry strategy and a clear exit strategy. that is not something that we like to look for in terms of building 80% of our portfolios. We certainly would like to hold companies for very long periods of time. I can tell you in the BCI equity fund, there are certain stocks that we've held pretty much since day one in the funds. We've got a number of shares that we've held for over 10 years, which is essentially the full lifespan of the fund. So that is what we look for, assuming nothing changes within those businesses. We believe that, we believe in the benefits and the power of compounding and earnings growth. Certainly not favoring the more cyclical sectors, which requires much more discipline on your exit out of them. And just to show, highlight once again, the fact is you haven't had a big growth tailwind to drive equity market performance. We haven't had rising income per capita levels, I think, for close to 10 years now, which is quite sad. I think our GDP per capita is quite similar to what it was in 2008 in South Africa, which is, for an equity guy, one of the key metrics that you want to look for to drive structural growth within your businesses. In terms of South Africa and its weighting within the MSCI emerging markets, very sadly, come down quite a lot over the years as China, one, grew, but two other emerging markets have come through. And South Africa is, I think, just under 5%, call it 4%, and Naspers must be a good 25% of that. So South Africa ex Naspers, which was at its peak probably about 15% of emerging markets, is now down to about 3%. So that is, once again, sets up an opportunity, because South Africa is certainly overlooked by many investment teams. You'll be surprised at how small investment teams are actually across emerging markets, and for them to dedicate resources to look at South Africa is quite a big decision for them. They do have finite resources across their investment teams, and to get a conversation away on South Africa is difficult. But what I can tell you is that there's a lot of PMs out there with very good memories of South African companies, and memories that go beyond what you've seen over the last 5 years, that they've got good relationships, the management teams get good access here in London, and when things turn for the better, I think that there's a lot of capital that could come back into South Africa and to the higher quality names that guys are familiar with. This is just another slide, once again, highlighting this diminishing influence South Africa has in emerging markets. So let's just tie this all back and how we think about things. So we've obviously had to sit in an investment team and go through this period and say, listen, guys, we need to go and fetch returns. The market is not necessarily there to give it to us. So what do we do? So the first thing is we need to be patient. Opportunities always seem to present themselves. Do not force things. We like to take longer term views on companies. Certainly when a huge dislocation presents itself, we will go in tactically, but that's not the core of what we do. We are long-term focused and want to benefit from the power of compounding. And for that, you can't just rush into things. You need to be very select when you go in and take longer term views. Quality, we believe that in this environment, the quality comes through. If you look at something like a ShopRite versus a Pick n Pay, it was clear 3-4 years ago that ShopRite had come over a capex hump, and that they had entered one of the most outstanding slipstreams that we've seen out of any South African corporate over the last 10 years. And they have absolutely destroyed the competition. So we would favor a company like ShopRite over a company like Pick n Pay or a company like Spar. Not to say that the opportunities in something like Spar is not worth looking into, certainly, because it's a turnaround play, but it's a far more complicated investment thesis to execute, and that's not necessarily our core competence or skill. And then we want to go for companies with clear catalysts that can drive outperformance regardless of what equity markets do. It's a very bold statement to say that those exist, but we believe that they do. If we look at things like an HCI, for instance, there's something clearly going on in HCI with regards to that oil fund off the coast of Namibia that presents a very idiosyncratic investment case. I mean, that the outcome on that oil fund is going to not rely on anything to do with South African politics, for instance. So those are the types of investment cases. But you're finding other businesses that we're going to touch on, a company like Advotech, which is able to hit. We've been long Advotech for a very long time. But also, what's been great about Advotech is just every time we sit with them, just the consistency and of messaging and delivery. This business is executed exceptionally well. And at times, a lot of people didn't think that that was going to be the case. But, you know, the business that's well run in the private education market in South Africa and tertiary, private tertiary education. And we believe that, you know, the top down just really married so well with the bottom up here. And it's a company that we think that we can keep owning over a very long period of time in South Africa. And if you look at the earnings delivery through a very tricky period over COVID, you know, they had the right levers to pull in terms of what they could achieve. It's not necessarily overly exciting, but it's certainly in the arc of those core compounders that we look for across South African equities. Another one that we can touch on quickly is Afrimat. You know, once again, a management team who we've built a very good relationship with over a very long period of time. I think we first bought Afrimat in 2016 when they'd just done the iron ore acquisition. They've executed exactly what we believed they would. So we believed that they would diversify away from the aggregates business and the specialist chemicals that they had, or minerals, into open pit mining. They've done that, and if you look at their track record of M&A over the years, it's been one that I think university students could do studies on. It's been so good. So we believe that, you know, in 5 years' time, with the acquisitions that they've recently done, this business is going to actually stand out across South African equities, and particularly in the mining space, as a real outperformer relative to what you can buy, which you can see on this slide. So this slide just shows you the relative earnings growth of an Afrimat versus what you can buy across the rest of South African equities. I mean, for us, if you can buy a business like that that's able to reinvest its capital for earnings growth, you know, that's a unique idiosyncratic investment case across South African equities and South African mining. So an Afrimat is something that we would favor, and we must be one of the only equity funds in South Africa to have this as a top 10 holding in our fund. But you know, listen, those are the levels of conviction. The sell-off that we've seen from, I think, 60 odd rand down to about 50 that you see today, we believe is technical in nature. There's the biggest shareholder is trying to exit its position, and they are selling shares en masse in the market, and we've been buying into that weakness. So that's the story on Afrimat. I mean, just the slide just highlights the relative growth that you're going to get from an Afrimat relative to the rest of the mining companies in South Africa, and that for us is something that, you know, you can expect us to want to gravitate towards. I then also just, you know, in the more larger cap space, I mean, the Standard Bank result and how this has played out has been quite unique across not just South African banks, but South African equities in general. 35% growth in earnings, or over 30 for this year. That's a really good outcome. That for South African banks puts it as a huge outlier across the sector. And what's quite interesting about Standard Bank as someone who grew up analyzing banks, and my background is in banks analysis, is that I always remembered Standard Bank as the company, as it reports, you're going to highlight three key issues in the numbers. They're overspending on IT. They've got a JV that's underperforming with ICBC Bank China, and Africa was always the elephant in the room. No one wanted to discuss Africa because it was a drag on returns of earning and capital. All of a sudden, those three issues are out of the way, and it's the potential within the Standard Bank franchise has really been unleashed. So Africa is generating great returns on equity of 28%. South Africa at 15 is probably in line with its cost of equity, but at a blended group return on equity of 19%, that is hitting those medium-term targets that no one believed that they could achieve 2-3 years ago. So, you know, all credit to Standard Bank. The Africa diversification that's come through has been good to see. It's been a good example of backing a management team. We didn't necessarily initially back it, but certainly as soon as they started coming through with delivery and confidence in their message, we were happy to back it. So, and at the same time, we don't think we're overpaying for it at 7 times forward and an 8% dividend yield. That multiple is certainly depressed right now as a result of that cost of capital issue we discussed earlier. But you know, as you highlight in the next slide, like the cost of capital needs to be blended across a lot of regions. and this business is diversified. So there is some kind of an argument to be made that the cost of capital, because of diversification, should be a little bit lower, although it is diversified into areas where the risk-free rates are also quite high. So, but in terms of Standard Bank, in the large cap space in South Africa, I think it stands out as a company that's executing extremely well. So those are three stock ideas. Some of them in the smaller caps, and then Standard Bank in the larger caps. And then, as Nolan did earlier, just a disclaimer slide just to tick that box as well. Yeah, that's our message.
Never forget the disclaimer slide as always. Liam, if only our economy could do as well as the box are doing, we would all be smiling, wouldn't we? Right, couple of quick questions from the audience on my side. Thank you, Liam, and thank you, Nolan, for that. Liam, you did touch on SA's beta to China. Speaks to one of the questions from the audience. Why are SA's economy or economic prospects so interlinked to China's growth metrics?
Yeah, good question. So let's unpack. The one is the stock market and the other one's the economy. But actually they both are. So the stock market, obviously the Naspers and the direct relationship from Naspers to Tencent is one of them. CFR is also got quite a strong direct relationship to the outcomes in China, because a lot of the Chinese, the growth is from the Chinese consumer. So pack those two stocks aside, but then, the real exposure is in the basic materials space. So if you take Naspers, CFR, and basic materials, you're looking at a large chunk of our index. But I could even go, and why basic materials? China is the largest consumer of our raw materials that we pull out the ground, whether it's platinum group metals, iron ore, copper, these things. China is ultimately the biggest buyer, sets the price, particularly in PGMs. It's not necessarily widely spoken about, but Europeans buy a lot of our PGMs, although the price is set. The PGM that the Europeans buy is on contract, but the price is actually set in the spot market, which is largely set by China. China is far more involved in the spot market on PGMs than the contract buyers out of Europe. So ultimately, this is all interlinked. I mean, China sets the price on a lot of these commodities that we export, and so if you take the basic material sector and then you take the direct relationship between Naspers and also CFR, that's a large portion of our index. Now, going back to the South African economy, as you could see 2-3 years ago when our mining receipts went through the roof, the year was 2021, I think it was. A lot of that filtered back into the rest of the economy. So all of a sudden, other parts of our economy benefited from that as well. You started seeing cost of capital coming down. The banks were finding more opportunities to lend. From our analysis, we believe the South African stock market, across multiple facets, even retail, which is linked to interest rates and ultimately linked to the fiscus, we believe that China really dictates the pace of play for us, directly and indirectly, and it permeates in many different places.
Very interesting indeed. Nolan, I want to test some asset allocation ideas with you, or your views, and speaking to your fixed income solutions and the application of that. You run multiple mandates, including a worldwide flex mandate. You obviously run balanced mandates as well. Given your positive views on global credit at the moment, is this something you increase your exposure to into more flexible or balanced mandates currently?
Eugene, obviously we have a process behind all of our mandates. I've sort of focused on the fixed income mandates, but yes, absolutely, our views as to the attractiveness of yield product abroad filter into our balanced mandates, filter into our worldwide flexible mandates. So, there's a definite tilt that takes place, obviously, within sort of parameters, depending on which portfolio we're looking at. So do I think, our balance fund, for example, is going to have a little bit more bonds, a little bit more offshore bonds? Absolutely, these are some of the things we're busy with.
And nice defensive plays if you want to be a little bit more cautious at the moment. You produce very interesting work and graphs on the rand versus the dollar. It's something we have to discuss if you talk about global allocation, given the current weakness of the rand and the dollar perhaps too strong. Just your views in the very near term or medium term going forward. Are we going to see a dollar that's potentially going to remain stronger for a little bit longer, with too many headwinds on SA's economy and recovery of our economy as well, especially commodity prices under pressure? Do you think the rand's also going to stay under pressure for longer?
Okay, lots of questions in there. So, the graph we produced basically says the fair value of the rand is 15. And the graph we produced also says the market doesn't believe us because the rand's trading at 19. So there's like a 4 rand gap, which is a monstrous gap. When we dig into it, where we come out is about 2 rand of that difference is because the dollar has been stronger. And, that's just a cyclical function that's going to come and go. And about 2 rand of the difference is just because South Africa's behavior has been pretty appalling in many areas. And, our own goals are going to cost us as well. So how do we look at it? I think as the dollar moves through the cycle, some of that dollar strength, probably towards the back end of next year starts to dissipate. So there's potentially a little bit of rand recovery, not where we would have been, but that 2 rand dollar strength, maybe you claw some of that back. I don't even think you claw all of it back, but that's kind of the range. What does that mean? It means we're modeling internally on the rand at 1930 for the next year. But, within that, the rand in the very high 17s, let's call it 18 to maybe 2050, that's a reasonable range.
Very interesting indeed. Maybe just Liam, back to it quickly, a question from the audience. To what extent are SA elections impacting on SA markets, and how do you manage your assets for the outcome, not knowing what the outcome will be? And I don't want to dive into political scenarios, but I think it is very relevant, if we go into election year and the impact it may have on our markets. How do you see that, and how do you position for that?
So a couple of things. One, the discussions within investment teams, not necessarily around South African elections, but in terms of what we've seen across the world over the last, and we actually believe it started with Brexit. So not necessarily what we've seen over the last couple of years, but left tail risk across portfolios is something that is dominating a little bit more of the conversation than was necessarily 15 years ago. So we have to model, or not necessarily model, but we have to sit and discuss left tail risk, which is these outlying risks that could hit portfolios and the ultimate stress within a portfolio as a result of that. And why do I say that? There could be a scenario that's really bad for South Africa. We're certainly not planning for that to be the case, but we have to be cognizant of that risk and know exactly which triggers to pull. We did that for Brexit. We did that for Donald Trump becoming president. We did that with the Cyril Ramaphosa. Remember how close it was, Cyril not necessarily becoming president. So we had already gone through periods like that. I would say the more direct focus right now is probably more linked to what Nolan discussed earlier in terms of going into an election year and spending. So we know that there's an election coming. We believe that it actually creates a bit of a tailwind for certain pockets of the economy, because we don't believe the government can cut spending in certain places, and we believe that where they won't cut spending is going to help certain companies. So in terms of managing for an election outcome, we're probably thinking about it a little bit more positively from an earnings point of view. But when I say that, what we've seen across the world is certainly you have to be planning for left tail risk, and you need to know before the market opens that day exactly what you're going to do in portfolios in a bad outcome. I wouldn't necessarily have that as my base case, but in terms of how you behave in an investment team, you have to discuss those things.
Interesting indeed. Very last question. Liam, again, you mentioned, your positioning being a little bit more defensive. An all-out equity fund, how do you do that? Is it that absolute focus on higher quality company with stronger balance sheets? Is that the only play, or do you think about things like gold plays as well?
No, so good question. We don't think gold companies are very good companies. I mean, there's no doubt as to the reaction in markets over time when political risk and geopolitical risk kicks up, that things like gold and oil spike. Certainly much more of a macro play that we haven't positioned ourselves for that at all. We don't enjoy gold, and we do feel uncomfortable when gold rallies as much as it does, because at 4% of the index, it does hurt you on a relative basis. So how do we position ourselves? It certainly is a focus on quality. There is no doubt that in our minds, we believe, and it's quite interesting for someone to say this. If I look across South African equity funds, how many South African equity funds have Bidvest as a top 10 holding in their fund? And not many, right? You actually can't. I can't think of any. And yet, look at the delivery of a company like Bidvest over time, and look at the share price performance that you've gotten out of it, right? So Shoprite is another example of that. So we are going to gravitate towards high quality companies. I think that on a relative basis, I think you can expect us to have a bigger tighter correlation to those types of factors. But that does make us a bit differentiated, I suppose, in the South African equity market, because guys, in South Africa, fund managers' mentality is far more focused on valuation and less focused on necessarily quality. But we believe, guys, in a very tough environment, nobody saw Pick n Pay going into losses this year. So we have to gravitate towards companies that we believe are going to withstand a very tough operating environment. And for us, it's quality, which has always been our mantra. So it just ties back within that.
I'm going to take. No, yes, you want to add to that, Dylan?
No, I don't want to add to that, but I do want to hijack I know we're out of time, but there was one other question. There are a lot of questions, but there was one that caught my eye that I wouldn't mind responding to. And that was the question of why are foreigners avoiding South African bonds?
Yes.
And it's actually an interesting one. And the answer is because the JSE can't measure things. There was an uproar about 2 years ago. I actually did a webinar on it, where the JSE was reporting mass foreign outflows. And then everyone else was saying, but we're seeing bond inflows. And they went and did a big reconciliation. The JSE was like, yes, but we don't include those purchases by foreigners. We ignore those purchases by foreigners. We ignore those. And we said, well, when you add everything up, actually, you're telling us they've sold bonds, but actually foreigners have bought bonds. This is ridiculous. And the JSE is, this is how we do it, guys, live with it. So anyway, so the JSE is merrily reporting bond outflows every day. That's great. But what is very interesting is Rand Merchant Bank, RMB, went and worked with the International Institute of Finance, IIF, and put an email out yesterday. And I don't have their whole sort of email here, but what I am going to share is an email that I put out on this. And what you've got here is a chart of IIF, so measured by foreigners, not this JSE sort of will count half the trades. It flows to emerging markets. And that bar chart basically shows you flows to emerging markets across bonds. And what is interesting is South Africa, if you sort of run your eye along the bottom, has actually, according to the IIF, seen inflows of $2 billion on a year-to-date basis. Very different from the JSE's numbers, but the JSE's already admitted their numbers are sus. So from that perspective, actually, it's quite good news. Firstly, South Africa's in the middle of the pack, which is kind of where you want to be. We're not, an outlier like China on the right there, don't own Chinese property bonds right now. And instead, we are, looking quite decent. And, it's not like we're in the sin bin like everyone feels. And I think it's quite a good news story. So I just thought I'd share that. Sorry for hijacking your presentation. I
really like that slide, and makes you wonder why nobody wants to invest in Chinese property. Right. I know we are very, very much out of time. I want to take one very last question. It's very topical at the moment. Impact of the Israel-Hamas war going on, Iran getting involved now as well. Impact on energy prices, and are you going to play energy in an equity fund as well?
Yeah, it's interesting. Usually when energy is going up, a lot of other things are going down. So, often it's similar to gold. I mean, it's often I look at the insurance the insurance benefits of owning those assets, and I almost think of it as like you buying 2% in gold or 2% in energy to try and hedge your portfolio is almost like trying to insure 3 windows of your house. You know, unless you're going to stick your whole value portfolio in it, like I don't see the benefits necessarily that much of it. Certainly, I'll tell you what's interesting about energy, and it plays into also our investment in HCI, is that there's clearly a scarcity of assets around the world. I mean, you've got the recent M&A that you've seen just this week and the last week with Chevron and Pioneer and Hess, and the mergers that you're seeing. There's certainly a push away from this direct focus that we've seen on ESG over the last couple of years, and people now are starting to worry about the scarcity of securing supply. And especially in a world that's becoming more fractured, we believe that multiples are being pushed up in certain places, or certainly scarcity premiums are being put on certain assets. So there's once again, tying back to the idiosyncratic factors behind an investment case, and that's probably where we would like to focus on more. I can't even begin to stress across, and I'm happy to say this across the entire investable universe, how many South African equity funds have got Sasol as like one of the bigger positions. It is one of the worst run energy businesses that we've spotted across our entire investment universe. Like over time, it has become so complicated and become such an underperformer. South Africa is Sasol, which foreigners still think of as a parastatal, like is now trading on a Russian oil company multiple. Like this thing has deteriorated to the point where there are so many better alternatives around the world to buying Sasol. It's just screening so cheaply, and you know that potentially presents opportunity within Sasol. But it's like that argument of Bidvest versus Sasol. Compare the two. Bidvest has consistently delivered, consistently looked expensive, consistently underowned, and Sasol's almost a juxtaposition of that. It's consistently looked cheap, it's consistently underdelivered, and it's consistently overowned. So it's like, you know, for us, it's not the type of business we like. But listen, running a South African equity fund where your investable universe is 50 to 100 shares, when a big index stock really underperforms, we have learned our lesson over the past not to get too dogmatic in our approach to running equities. We will go in and say, is the asymmetry just at that point too big not to own it? And that's probably when Sasol starts to look attractive. I don't think we're going to see 20 Rand again like we saw 2 or 3 years ago. But certainly, if it starts to look, you know, if it starts to make Russian equities look cheap, then Russian equities look expensive, then we'll probably go in. Yeah, so that's how we are at Sasol. But I don't have a strong view. Don't worry.
Gentlemen, you've made a really good conversation this morning. Very insightful indeed. We are totally out of time. To our audience out there, I know Anchor produces a lot of really high quality documents and research documents and papers. A lot of that can be found on the Boutique Manager's website, or get hold of one of the BCI team members if you need more information on any of their funds or the material they produce. The funds that they discussed this morning are available on all the major platforms, really interesting options there. Liam, Nolan, thank you so much for your time this morning. I took a lot more than what we thought we're going to, but it's been so insightful indeed. Quick reminder, next week, Wednesday, the 1st of November, we're going to have a really interesting conversation with Granite Asset Management. And I hope to see you again next week, Wednesday. To all on the team, thank you so much. Liam and Nolan again, thank you for this morning. Really appreciate it. Thank you.
Thank you.
Yeah.